I'm Rich Friesen. I'm the founder of the Mind Muscles Academy, and welcome to this webinar. We have the privilege of having Peter Davies. Peter Davies day trades the E-mini 500 futures with a heavy emphasis on order flow in the decision-making process. He is the founder of Jigsaw Trading, a provider of innovative trading tools, rated the #1 trading software product on independent review site Investimonials. Congratulations.
Thank you.
Peter is also the author of Order Flow Foundation course, a freely available course considered one of the best educational resources for order flow practitioners, and in use by a number of proprietary trading firms in their intern training programs. Peter regularly contributes articles, videos, and live educational webinars like this one to lead trading outlets. Well, I like that. Mind Muscles Academy is a leading trading outlet. That's great.
Absolutely.
Okay. So, Peter, I'm going to turn it over to you. I'll kind of keep an eye on the questions that are coming in and save them up for the last. So
okay.
Go ahead and share your screen. I'm going to turn my video off so I don't upstage you, as it were.
Yeah, okay. Well, thanks a lot, Rich, and thanks to all of you for coming. What I'm going to do is I'm going to turn my camera off and then switch over to the screen share. Just give me 1 second. Okay, and there we are. Okay, so you should see my first slide, order flow, keeping it simple, practical, and effective. And as the title says, today we're going to discuss some of the benefits of using order flow in trading and what I look for personally when trading with the Jigsaw tools. Now, I'm going to try as much as possible to keep this light on trading jargon because I know there's a lot of terminology that people don't understand. But for those that don't understand some of the terminology I do use today and you want to learn more, please take a look at the free Order Flow Foundation course on the Jigsaw Trading website. It's straight up there on the training page. There's nothing to sign up for or sign in for. As I say, I would like to hold questions till the end because I should be able to clear a few things up as we go along. Now, what is order flow analysis? Well, tape reading and order flow analysis are basically the same thing. So we can use those terms interchangeably. You're watching the flow of orders and their impact on price to see how market participants are acting and where they may be getting trapped. So it's being in a mindset of putting yourself in other traders' shoes, evaluating where other traders are positioned and how they're likely to react to certain price points. Then, of course, you're seeing if that reaction is really playing out in real time. So most trading methods, rightly so, focus on identifying an area to take a trade. And there's nothing wrong with that, but it is just part of the story. So you identify these potential trade locations because you expect traders to act a certain way when price reaches that point. And analyzing order flow allows you to see if the trader behavior really is changing or continuing, if you're a breakout trader, as expected when price reaches that location. And this allows you to confirm trades before you take them and also helps you manage trades by monitoring whether the majority of traders are turning against you once you're in a trade. Now, order flow analysis is a discretionary skill. And if you bring order flow into your trading, you actually need to embrace that fact. Now, understand that discretionary doesn't mean no rules. And there's also no law that says a discretionary approach should be more difficult than a mechanical approach. In fact, the process that many people go through of working their way through hundreds of mechanical trading systems, trying to find that needle in a haystack is a little like, trying to find a needle in a haystack. It's all or nothing, right? You found the needle or you didn't. It works or it doesn't. You didn't necessarily progress with each failed attempt. But with a discretionary approach, you're more focused on developing a skill. So your progress is in steps. It should be visible and it should be measurable. You will know that you're improving because you can see the improvements, and also you'll know when you're not improving anymore. Now, most traders I know use price charts to define where to trade and order flow to reject or refine that entry. But there are some traders that happily trade using just order flow and no charts at all. And we're not going to cover that today, but again, there is a free video on our site called Day Trading Without Charts. Just type that into Google. And that explains that approach to trading without the charts. So order flow, it's like reading a story. And as you know, all stories are different, but they do share a common language, and order flow too has its own language, and that language describes the behavior of traders. So a good example of this would be a market where sellers are predominant and price is moving down to a level of support. Now, as you move down to or a potential area of support, you might see one of the following things. You might see that large sellers are no longer participating, but the market is still moving down on small retail participation. And what that tells us is the behavior of some participants is changing.
Peter, are you changing your screen?
I did change it then, yeah. Can you not see it?
No, we're still on the title screen here.
Wow, okay. So what do I do to fix that? Do I need to
There we go.
Yeah. So large traders stop selling, yeah? Okay. Right. Okay, so we could, so let's get to the next one, sorry. We could get to support, and sellers are hitting us into the price aggressively before, during, and after we go through the price. So in that case, there's no observable change in behavior. We could get to a support area and nobody wants to sell at a certain price. We retrace a few ticks, go back to that price, and again, nobody wants to sell. So there's a clear and observable change in behavior, which is a lack of commitment at one or more prices. Sellers no longer present in any appreciable quantity. Another thing we could see, we get to an area and sellers keep hitting aggressively, but the market is not reacting to that selling. It's no longer moving down. And what we can see here, what's happening here is sellers are getting trapped. The bidders are absorbing that selling. And finally, we could get to the area and it suddenly ticks up with large size trades, obvious buy side aggression, and buyers are initiating a new move up. Now, many people will say at this point, well, order flow can't really work because it's short-term analysis and HFTs are dominating that time frame. But these order flow events, they take minutes to play out on thicker markets like the E-mini S&P 500 and a lot longer on like US Treasuries, very thick market. And it's a bit like saying, well, swing trading can't work anymore because day traders are dominating that time frame. So for now, I just ask that you suspend any belief that HFTs have in any way made trading impossible. Because any of you that take a few days to watch for the things I'm going to show you today will see they are actually reasonably clear and that you do have time to act upon them.
Yeah, I just want to identify HFTs is the high frequency traders, the automated traders. Go ahead.
Absolutely, absolutely. And there's always an excuse for why you're not making money, and a lot of people pin that on HFTs right now. And I think you have to look inward more than outward for the reasons you're not making money. Now, if you're watching, say, a 5-minute bar chart, you might not notice the difference between the scenarios we just discussed. You would see perhaps price go down to support, maybe through a few ticks, and not really have any idea if the behavior of buyers and sellers was changing. And with no appreciation where the bulk of people got positioned and where the stops got run, where it went doesn't give you the whole picture. And this image is very typical of that dilemma. So we'd normally, looking at charts, we'd look at the low and the high of a move for support and resistance. But if you look on the right, the volume profile shows that right now, that's not where the bulk of traders are positioned. So we've not seen evidence of a stop run to the upside because of the poor volume outside the bulk of this trading. There's very little volume to the upside there. So we could presume at this point that the shorts from this area of high volume are most likely still in the market for now. And price moves alone simply don't tell you that. Now, of course, I'm not suggesting that your analysis will always be 100% right. I'm just suggesting that this market mindset of understanding where positions are and which side of the order flow is on is going to make you more right than a study of price alone. And on the other side, that doesn't also mean that charts are useless. In fact, the more volatile a market is, the more useful charts become because there are more places where people got stopped out previously. So on markets with very low volatility, such as the US Treasuries, proprietary traders will find it enough to just look at a daily chart before the session starts and then trade without any intraday chart at all. They will just trade the order flow. And there are some proprietary trading firms that have their traders start off trading without charts, and only once they're profitable without charts will they let them incorporate charts into their trading. And I know that's going to sound backwards to a lot of people, but it's just the way it is in the prop world. Now, order flow analysis also looks at the behavior of resting orders or limit orders in the market and how they're being manipulated, either hiding their real intent or putting in large orders to deceive you into thinking the market is stronger or weaker than it actually is. So we often see iceberg orders where only a small amount of liquidity is shown, but the actual supply or demand is much higher. And we see spoof orders where the orders simply disappear when price gets close to them. Now, watching this activity of the bids and offers certainly helps us understand the behavior of the more predatory traders, but as we'll see, this is certainly not the most important order flow information you have to hand. Now, don't think of order flow as just one set of techniques. All order flow tools on the market, even all the free ones as well, are all based on a common set of concepts. So think of order flow in the same way that you think of price charts. Order flow tools present certain information in hopefully a logical manner. And like price charts, there's lots of ways to use that information. So there is no one way to use order flow tools. It is just information that you can utilize. But there is one thing you should do if you decide to adopt order flow, absolutely, without doubt, is keep it simple. Now, many novice traders go through a period of adding more and more indicators to a chart, looking for that perfect combination of indicators to tell them when to get into a trade. They add more and more things to their chart, trying to assist the decision-making process, but actually do the opposite and end up not being able to make a decision at all. It's that analysis paralysis. And as traders progress, they realize that more is not necessarily better. And over time, most successful traders drop the majority of their indicators and keep their chart simple. Then many of these same traders that saw the wisdom of keeping their chart simple, they make exactly the same mistake when they adopt order flow. So instead of keeping it simple, bringing in one or two order flow elements at a time, they take every order flow indicator they can find off the internet, add them to their screens, and end up with exactly the same analysis paralysis. So it pays to keep things simple and not turn this into a science project. And those that keep it simple will see progress in hours when they adopt order flow. And I'm not talking about 10,000 hours. I'm talking about 10 hours, okay? Now, this doesn't mean you're going to become an expert in 10 hours, but it does mean you will start to see patterns recur after 5 or 6 days of watching the order flow if you follow the startup process that we prescribe. Now, if you're starting out with order flow, you'll probably have a desire to focus on using order flow to help you enter trades. And there's absolutely nothing wrong with that. But for many traders, it's easier to focus initially on using order flow to manage your trades, to decide early on whether this trade will work for you or not. And that way you can make your losses smaller. So often you'll see a trade go your way a few ticks, but realize it isn't going to work for you because it's hitting a stopping point in the order flow. And you can often cut a trade at a small profit before it goes against you. Obviously, this does presume you don't do the rabbit in the headlight things and freeze up when you see it, because there is obviously a difference between knowing it's going to turn against you and reacting to it. And I think that's obviously Rich's domain. And the reason that we say, focus on managing your trades first, or the reason we say it's easier, it's simply because for those new to order flow, it is easier to gauge momentum than it is to gauge if the market's turning around. It's just a simpler thing to do. So as you study order flow, just keep in mind that your analysis doesn't stop once you enter the market. Those first few minutes of being in a trade is when you have the greatest risk of losses. So if the trade looks to be an obvious loser because of overwhelming order flow against you, there is no point in staying in, hoping that it will turn back before it hits your stop. Now, on the other hand, when a trade has gone your way and you have some breathing room, there's really no need to focus so intently on the order flow. You can relax and you can let the trade work out. So order flow isn't something you need to obsess over every tick. It's a tool you use at appropriate times. Okay, and here are the Jigsaw tools. The charts on the Jigsaw tools, but everything else is the Jigsaw tools. But the tools are a plugin for multicharts.net, NinjaTrader, and the OEC Trader platforms. And OEC Trader is also known by many names: S5 Trader, Apex Trader, Alpha Trader, CTG Pro, DT Pro, GeForce Trader, Global Zen Trader, Zania 360, and probably some of the ones I've forgotten. Those are the platforms we support. And we'll just go through the tools one by one. First of all, over on the left-hand side, this is something called the summary tape. And it's a side-by-side summary of time and sales, or a side-by-summary recording of the trading activity. Now, it doesn't show individual transactions, but a summary of them at each level that trades. And as we move to a new level, we get a new line in the summary tape. So we can see we've got red and green lines, and red denotes I ticked down from this price, and green denotes I ticked up from this price. So we have the bid side on the left and the offer side on the right. We have the prices on the outside and we have the trades on the inside, and then over on the right is something we call the delta, which is basically buy market orders minus sell market orders. Now, there is some overlap in the functionality between this summary tape here and the screen over on the right, the depth and sales, but I keep the summary tape open because it generates audio alerts for various order flow events, such as iceberg orders being executed. Okay, and we can also see those alerts on the chart. Now, some customers prefer to watch the summary tape to get into the flow of orders. I don't. I focus more on the depth and sales. So for now, we'll just get rid of the summary tape. Now, normally, I'll just say at this point, I would normally show the tools live, but obviously with the market being closed or dead, I'm using slides today. Okay, so over on the right here, this tool is something we call the Reconstructed Tape, which is Jigsaw's version of time and sales. It's like time and sales on steroids. And it's also good, it's always good to know which side of the market the larger traders are on. So I tend to only watch the larger traders on here. And there's two main things I look for when I'm reading the tape. Okay. First of all, if you're in a trade, you want to see large traders on your side. Now, there will always be large trades on both sides, but you want to see the majority on your side. So if I've just entered the market and there's a flood of large trades against me, and importantly, because we've always got to think about what price is doing, and price move against me, then I'm going to consider my trade to be in peril. But what might come as a surprise is the usefulness and frequency of seeing where large traders are trapped. And it certainly was to me, because I'd sort of gone along this presumption that with order flow, the large guys were infallible. You follow the large guys and you make money. And it isn't that cut and dry. And in fact, a lot of the time, the large players being offside is a much better signal than trying to follow the large guys. Okay. Now, there's a lot of large traders that are playing for very, very small moves. And there's, in fact, these markets like the 60 and the S&P 500, there's a lot of big one-tick traders. Okay. So these aren't eight-tick stock traders. I'm talking about guys who throw 300-400 contracts at the market. And I know a guy who trades 500 contracts on the ES, although right now he's had to scale back with the reduction in liquidity. So these guys are throwing contracts at the market quite often. And of course, they're going to get caught offside. And when they do, it causes a reaction. So on most days, certainly on the S&P 500, it's quite clear, and it's one of the first things you should look out for. And the way it goes is this. You'll see large trades followed by the market moving in their direction. Then more large trades and more moves in their direction. That cycle of large trades and a move will continue, and then suddenly you'll see that the large traders are not getting any movement their way. And there's a pause. It's like sometimes like 20, 30-second pause. You'll see them, boom, 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 moves up, boom, 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 moves up, boom, 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 no move, boom, boom, no move, boom, and no move, and there's this pause, and it sinks into them that it sinks into them, and then boom, market moves in the other direction. Partly because these guys know they're trapped and they get out of dodge, and partly because predatory traders are trading against them. But you see this every day, but you don't necessarily want to jump on this as a standalone signal. So don't take that away today, and tomorrow just trade every time you see that. You want to see this in context. Like a lot of order flow signals, you want to look for these in context, because the reaction is going to be fairly small if it's in no man's land, and most retail traders need to get trades where there's a bit of follow through, with the commission structures and all that. So by context, I mean that you want to see this around an area that you already wanted to do business, and that could be because you identified the area pre-market, or because of the developing action. And I'm a big believer in intraday volume profile, so I use that. So with good context, you have more chance of follow through. You have more causes at play and a larger effect. So I'm usually looking for this, as I say, a pre-market level. So I did my pre-market prep, I define levels, a step in the intraday volume profile, or something I call a measured moves, a move. And measured moves don't involve much more than just being aware of the average swing sizes in the market and watching the action when the current move is approximately the normal swing size extreme. So this means I'm not watching this recon tape all the time. I'm glancing across every few minutes, and then a little more frequently as we reach an area of interest. Now, I personally only watch for the large trades on the tape. And I also have it filtered to show just the large trades for the last 3 minutes. So I know that any time I look across at this, I'm only looking at recent activity, because you see I don't even have the time out there. I just want to be able to boom, look across, absorb it, and then get back to what I was doing before I looked across. Now that's just one way to use the time in sales. Some people like to watch all the trades so they can get a better feel for the kind of pace of the tape, and there's nothing wrong with that. But I prefer to get the pace of the market from the depth and sales, and there's no trader that can watch everything. So you have to pick the few things that resonate with you the most, and this is just, for me, what resonates the most. Now over here, the colorful screen with all the scary numbers on is the depth and sales. And this is a fully functional trading dome with many additional features unique to Jigsaw, designed to make it easier to absorb the information. And some of those features will be obvious to even a casual observer because they're in additional columns that don't exist on other domes. Other features are more related to the way it flows, the feel for the market it gives you. So for those of you who know the dome, it would be a reasonable comment at this point. So, well, that dome, the Jigsaw Dome, appears harder to read because it's got more information on it. And that additional information is there to reduce the amount of recent history you have to remember when reading the dome. I mean, one of the things is I've got the memory of a goldfish, basically. And when somebody showed me the dome and how to trade off it, it just required a really good short-term memory, mental acrobat, I call it. So what we try to do is take away the need to perform a lot of mental arithmetic and remember what was each level a couple of seconds ago that's necessary when reading that traditional dome. So our claim is that we present more information but make it easier to read, and that can only work if you aren't trying to read all the information at the same time. So let's go through the information on the screen and I'll tell you what I read and when. So first of all, we have the bids and offers just like every other dome. And you can see on here that some levels are highlighted, and that's down to a feature of the product that highlights trades above a certain level. And that helps to draw your eye automatically to areas of interest. On thin markets, there's a tendency for large orders to get taken out and then the market swiftly moves the other way. So thin markets, I'm talking about things like the Dow, crude oil, those kind of markets. On thicker markets, with more liquidity, with more, bigger numbers on here, like the S&P 500, the US Treasuries, it's somewhat different, mainly because people putting in spoof or fake orders have time to get out of the way if the market trades towards them. Because basically, there's no such thing as a spoof or a fake order. You can only put in real orders. So whenever they want to make the market look weaker or stronger than it is, there's a risk associated with doing that, the risk that you might get filled on an order you didn't want to fill. So if you're on crude oil and there's 100 contracts in front of you, that's risky. If you're on the S&P and there's 3,000 contracts in front of you, it's not so risky. So on a thicker market, they can spoof safely closer to the inside bid and offer, to the current price. But in both cases, those large bids and offers are worth looking out for. So in terms of bids and offers, I look for just a few specific things. So if I am long, I want to see decent sized bids below me, preferably following the move up. So on the ES, the S&P 500, if I'm long, and of course we're in quite low liquidity time right now, it's nice to see like a 1,500 lot bid below me and see that to step up as price moves up. That's a nice thing to see. If I'm long though, I don't want to see massive bids below me. So again on the ES, if I'm long and I see 3 or 4 levels below me suddenly have 3,000 contracts per level, I'm wary that this market might suddenly go down as these fake bids get pulled. Still, you've got to remember that these spoof moves, they're not kicking off a full reversal. So it's often just faking people into the market for a 4 to 6 tick drive against them. So if you're already in a trade and you've got a lot of breathing room, you've already maybe scaled some off, or you're already 3 points up, it's not something you should obsess over. But if you see suddenly massive bids below you and you're long and you're close to your entry price, that's not a good situation to be in. Now, the other thing that might surprise you, if you see excessive offers at a high or resistance, or if you see excessive bids at a low or support, it doesn't mean much. I wouldn't say it doesn't mean anything, but it doesn't mean it's going to hold. So it's very normal to see that at support and resistance, and it is not indicative that the market's going to hold. In fact, at any point of support or resistance, you should see bids directly below support or offers directly above resistance larger than normal. Okay, it does not mean the level will hold, but it does mean that other traders are watching that level, and that is a really good way to validate your analysis. So if the bids and offers as you approach levels that you're defining are normal, there's no anomaly, there's no extra size there, you should not expect a reaction either way. Okay, and also you might want to rethink the way you came to that level, because you really want to be looking for areas that you will get a reaction. So not just a place that you and a couple of other guys think is going to turn. So you need participation to cause a reaction. And one of the signs that a lot of people are looking at a level are basically high bids or offers the other side of that level. Now, if you see excessive bids or offers elsewhere, what you need to do is look on the other side. So if you see excessive offers, check out the activity on the other side. Okay. So a good example of that would be a market that's just come off its high, and it now has massive offers, but this time below the high. It makes the market look weak. But on the other side, on the bid side, you see an iceberg order, and we'll explain what icebergs are in a short while, so those that don't know what that term means. So you have big offers above, and you have sellers selling, but somebody on the bid side is absorbing that selling, and price is having a hard time moving down. So that trader on the bid side that's absorbing the selling is going to be the same guy with the big offers above. And when he's done buying from the sellers, he's going to pull those offers out of the way, and he's going to start buying and push the market up, forcing the other sellers to exit their positions by buying and pushing the market up even more. And that sort of activity is known as flipping the market. Now, I wouldn't recommend trading with that, partly because there's all sorts of reasons that attempt to flip the market won't work. So effectively, you're putting your eggs in the other guy's basket. But it does pay to be wary of it. So if you're short and you see those abnormally high offers and you see the absorption on the bid side, you see the selling having no impact, and you've just got short, be really wary, because that's one of the signs that the market's about to move against you. Now, between the bids and offers is something we call the current trades. And on the left side, we have the sellers in red selling to the bidders. And on the right side, we have the buyers in blue buying from the offers. And this information is by far the most important order flow information you will use. And most order flow tools are effectively showing you this information. So this is your focus, and this is where you see those behavioral changes. Now, these numbers are cumulative. So each time there's a trade, it adds on, but it will reset when you come back to a level later on. Okay, so if I moved away from this level now and then came back, these numbers would reset. So we're seeing what is trading into levels this time round and what the result is, because we can see if it goes up or down. And we advise all people new to order flow to initially focus just on these columns and nothing else. So we're looking at the totals traded here, but we don't see the individual trade size. We don't know if these are big trades or not. And that is why I keep the reconstructed tape to the right. So one place to see the totals and one place to occasionally glance across to see if the individual trades are large or not. And we can see there was a big seller here at 129. Obviously, probably a bit more than 3 minutes ago. Now, the things that I focus on in the current trades, very specifically, and this is the same for any order flow tool. First, the proportion of size hitting each side. So when the market's trending, and by that I mean an intraday trend, not a long-term trend, usually on the way down, the sell size is 1.5 to 2 times the buy size, and the reverse on the way up. And I'm looking for changes in that behavior. I'm looking for that to flip over. You're also looking at ticks up versus ticks down, or moves up versus moves down. And that's one that's kind of harder to explain theoretically than to see. But sometimes the market seems to hold moves more easily one way than the other. So you might see the market move up to a point, it ticks up and it stays up for just 1 second, then it drops down and trades 45 seconds before ticking up, staying up for just 1 second, then it drops down again. So it's not able to hold those ticks up. And again, that's an early sign that we might have a short-term reversal coming up. And within context, that can play out into a long-term reversal. So you're watching how it's moving up and down, that pace, and that stickiness, how easy it is that to stick prices up versus price down. I also look for areas that no one or very few traders want to trade. So it's very, very common to get to a price and the first time there, nothing trades. Then it pulls away, goes back, nothing trades there again, or just a handful of contracts. And it can often do this 3 or 4 times before the other side takes initiative and steps in. And that's simply because they're seeing it as well. They got to a point, nobody's hitting the market anymore. So they'll try and push it the other way and see if they can get the market, get people to stop out. Now, I also look for areas where excessive volume trades. So we may see a move down, seeing 500 contracts hit the bid, then we tick down, then 600 hit the bid, then we tick down, then 400 tick the bid and hit the bid, we tick down. Then 3,000 contracts hit the bid, it doesn't move down. So a bidder just stepped up and absorbed the selling. So now those later sellers are trapped, and it will just take a little nudge up for those guys to get stopped out, and that could then start a move that gets perpetuated. So it's here that those order flow patterns occur over and over again, and that's why we have people focus here first and use all the other aspects of the product to kind of supplement that information. Now, I can't go through every pattern you'll see, and there are people, absolutely customers, that will see things that I don't see myself, okay? Because this is just a tool and how you use it is up to you. But we do have a way to teach you. We have exercises that will help you to see these patterns for yourself. Now, over on the right, we have a bid offer profile showing you what hit into the bids and the offers at each price. And once again, we're seeing red prints for the sellers that sold to the bids, and we're seeing blue for buyers that bought from the offers. And this one does not reset like the current trades. It shows the total for the session. It can be manually reset. So maybe if we've moved down and hit what we think is a low, we can reset what's above us. So when we move up, we're going into fresh ground again. Now, over on the left is the volume profile, okay? And this is showing all trades at each price. And we have the developing value area for the value traders in orange. We have a purple point of control and a lime green VWAP. Now, for seeing when traders are trapped, it is very useful to use this bid offer profile, okay? For right here, right now, our traders getting trapped. But when you return to an area, I believe the volume profile, a simple trades at price, is most useful. And that's because as traders get trapped, it often shows as an imbalance on this bid offer profile, just as it does on a footprint chart. So you might have buyers still predominant, but the offers absorbing the buying. And so you'll see more buying than selling, but you'll see it's an imbalance because there's no move up. It's a trap. But once you leave the area, any imbalance, and I really mean this, any imbalance is meaningless. And there's a reason for this, right? Every trade that we see is a buy and a sell. The market is just a place for buyers to meet sellers. So when you build volume in an area, you have an equal amount of longs and shorts, right? And when you leave the area to the upside, the shorts will at some point get stopped out. So let's just look at this area here. We've got slightly higher volume here. Let's just imagine that we moved to the upside and we got to 134 and the shorts got stopped out. When we come back to the area, the guys that got stopped out aren't going to want to short the market in the place they just got stopped out. So there's a tendency when you return to an area where people got stopped out for the market to get back to that point, test it, and all of a sudden the sellers disappear. I mean, everybody can see that sellers just got stopped out. The buyers are happy. The shorts are done, basically. And it doesn't really matter whether they got short because they were a bidder or, they got short because they offered that price, or they got short because they did a market sell order. It doesn't matter, right? So basically the volume profile is key when you're looking at returning to areas, when you're looking at where people are positioned, okay? Now, if you watch volume profile intraday, you will quickly see how trends develop. So you get a move, and then you build some volume in an area. Then you have another move, and you build volume in an area. And this happens on almost all intraday markets that speculators trade, okay? So you watch now and watch any volume profile, doesn't have to be Jigsaw. Watch how those volume areas hold, okay? Because what you'll see, you build volume in an area, then you'll break to the upside, and then it'll come down and test that area, and it will hold, and then you'll move up and make your next move. And then also look at what happens when one of those volume areas breaks against the trend, okay? And because it usually signals the end of the trend. And again, it's all about who got positioned where and who is still likely to be positioned there when you come back. So yeah, I use this bid offer profile or a footprint, you could use for momentary imbalances, but really my main focus in terms of developing intraday areas I expect to have a reaction is just a plain old simple volume profile. And again, if you check out our free training page, there's some more in-depth videos on volume profile analysis to look at. Now, on the topic of trade locations, this column on the far left is there to just put your levels in from your pre-market analysis. And again, I couldn't believe nobody had put this in the Dome before us. Very simply because you do your analysis before the market opens, you have levels you're going to look at, and then you're looking at the order flow. It's nice to see your levels on the same screen that you're looking at, okay? So you don't have to take your eyes off the order flow, and this is your context, this is your pre-market analysis levels. Now let's move on to something called the Snapshot. So this is one of the features that helps to reduce the memory skills you need when you're using the Dome. And it shows traders very simply adding or pulling contracts from the Dome, if traders are getting out of the way or if they're becoming more confident at defending a level. And like the current trades, this is also based on this time round. So when the inside bid and offer moves, when price moves up, this gets reset and we see the pulling and adding at the new level. And most of the time, this is of absolutely no interest to me at all. And what I do use it for is this. First of all, to identify iceberg orders, okay? So we can see what is bid or offered at a price. We can see how many contracts are traded, and we can see how many contracts have been added. And that's very rich information to assess the size of an iceberg and how much refreshing is occurring and whether we have a realistic chance to join the iceberg. And in this example, what we can see, we've got an offer size of 25 contracts. We've actually got 2,204 contracts traded. And while we've been trading there have been 2,179 contracts added to the offer. That is an iceberg order, okay? Now on this iceberg, we can actually see the amount offered is quite low. So if you wanted to join that, for instance, you want to say, well, I want to join the offer there. I think that's going to go down. I'm going to join the offer there. If you see the bid quantity is only 25 there, or even a couple of hundred, and it keeps refreshing and staying at a few hundred as sellers trade into it, or as buyers trade into it in this case, you've got a fairly good chance of getting a fill if you join the iceberg. Now, on the other hand, in other cases, they're doing the same thing. They're adding contracts, but the offer quantity here, they're keeping it a higher number, maybe around 1,000. If you join that, if you try and join the offer there, you're probably not going to get a fill. Chances are you're not going to get a fill, because by the time you see the quantities traded to make an iceberg, and there's 1,000 there, you still need another 1,000 to hit it. Okay, very, very simple stuff, but only applicable if you're just about to enter the market. So I say you don't use it all the time. Now I use Snapshot to finesse an entry. So most of the time I'm waiting for the market to show its hand in the order flow at an area I want to do business. So that means I don't have a resting limit order at the price I'm interested in. So let's just say, for instance, I want to go long. The order flow is confirming the sellers are weak. I think the sellers are done. Okay, so I'm now watching the bids and offers and the pulling and stacking. So my mouse at this point is hovering over the dome right here, ready to hit into the offer when I think it's going to break to the upside. So I'm waiting for these offers above to start pulling out of the way. And also nice to see the bids below to start adding some contract. Okay, so I'm waiting there for these offers to pull. All of a sudden, the bid pulls, market ticks down. Okay, I'm still ready to go long, waiting for the offers to pull. Bids pull again, ticks down. And this goes on. Next thing you know, with 4 ticks down, the offers are still strong, the bids are weak, and I'm still not long. Then maybe I'll look at the recon tape and the current trades and maybe decide, well, maybe it's not a good idea to go long anymore, or maybe it still looks okay and I'm now getting in at a much better price. So other than that, really refining just when I want to get in, I'm not really interested in that snapshot most of the time. Some people swear by it, but for me, it's purely an order entry tool. Now, we also have something we call power meters or strength meters. I use just 4 of them, but let's have a quick look at the 6 of them. So over here, we have a meter that's showing just the trades, and we've got buy market orders in blue and sell market orders in red. And that's a running total of how many sell market orders hit the bid and how many buy market orders hit the offer, okay? And you can reset that anytime you like, okay? So if you ever want to reset it, markets move to low, you reset it, you're expecting the buyers to step in. It gives you an easy way because, there are some people who can watch a time in sales and kind of mentally figure out what proportion of buyers and sellers there are, but it's beyond me. It's beyond me. The middle one is showing the depth, and that's something that I don't generally use because I'm watching the depth anyway on the depth and sales. And the one on the right is giving a visual representation of the snapshot, and it's not a straight representation. So for instance, let's look at the bid side. So I've got 1108 here. That 1108 consists of everything that's being added to the bid and everything that's being subtracted from the offer, because it considered those to be bullish. Okay. Now these depth and snapshot meters can be set to just show a certain amount of depth. So really 5 is more than enough for a thicker market. For thinner markets, you'd set that to look at more depth because the outer levels have more significance because you will take less trading to get there. Now I use this current trade meter only once I get into a trade. So we have the option to clear the current trades and the strength meter when you're into a position. So let's just see that in action, what it does. So what's happened here is you've entered the market, and what happens after you enter the market, if you want, it's an option, it will clear the current trades and it will reset the strength meter. Okay, so now you're able to make a distinction between price moving against you and order flow moving against you, because now you're purely looking at the order flow since you entered your trade. So I don't mind price moving against me as long as the order flow is weak to neutral. So if I'm long and the quantity of sell orders is double the buy orders and price is moving down, I'll absolutely cut that trade. Okay, but if price is moving down and there's really not a lot of selling, it's just it's just wiggling around, then I'm quite happy to stay in. Now the strength meter on the right that represents a snapshot, what you're going to see when you have momentum up is that price will tick up, and then immediately after ticking up, this meter will go mostly blue. The market will tick up again, it'll go mostly blue again. And as the market weakens, that will flip from blue to red. So that's a good visual heads up to the momentum fading. Now, the absolute numbers there are important. So if you're seeing like 10 on the blue side and 3 on the red side, it's not significant. You actually need to see numbers in the hundreds. Now, down here, we have some other trade strength meters. So again, we're just looking at trades here. This is associated with the Recon tape. So in this case, this is actually just showing the larger trades from the reconstructed tape. So it's showing the trades that you can see on the screen, the filtering basically. And we also have some short-term power meters showing trades in this case from the last 60 seconds and the last 300 seconds. And again, the reason that's there is so you don't have to keep resetting the meter up here. You can just eyeball down and see if there's any shifts in the order flow. And you can set the time period yourself, and you can also set whether you want to show the filter trades or you want to show all trades. We have another meter here in the alert column. This allows you to eyeball the relative size of the bids and offers as well as the pulling and stacking in the inner bar. And again, this isn't something you'd use if you've got all the other meters showing. It's not something I use, but some people are just more visual, and it makes more sense to them to use those numbers than to use the depth. Okay, it's just a personal preference, so not one I use personally. And finally, all of the tools have a little chat icon, and that takes you directly to our free Jigsaw chat room where you can have a chat with other traders. And we're one of the few vendors that actually likes to get our customers talking to each other, and mostly this is active in the morning of the US session, so about 8:30 a.m. Eastern time to noon. And trading can be a bit of a lonely endeavor, and if you're trading in a prop shop, you've got other guys to kind of have a talk to and BS around. So it's good to have a group of like-minded people to chat to and bounce ideas off. And I attend the room, but nobody runs or moderates it. Everybody's equal in there. And if for nothing else, it stops you from putting in boredom trades. Absolutely. Because you've got somebody to talk to in the dead spot. And that covers our quick introduction to order flow with the Jigsaw tool. So it would be a good time to start thinking about your questions, start typing them in. Now, as I mentioned earlier, this should not be rocket science, right? We recommend that people start with order flow by just watching the trades print, those current trades on depth and sales, and just for 60 to 90 minutes at a time, okay? 1 or 2 times a day, no more, okay? And within 5 or 6 sessions of doing that, you should be seeing certain things play out. You should have that aha moment with order flow. It doesn't mean you're going to be an expert after 5 or 6 sessions, but it does mean you'll be able to start thinking about how to incorporate this into your trading. And we do believe, obviously, we have the best software for those wanting to incorporate order flow into their trading. And we are actually right now the top rated financial product on the independent review site investormanuals.com. We're number 1 out of over 10,000 products. We have seen many traders turn the corner in their trading with the help of our tools, the free training, but most of all their own hard work. And you can go ahead to Investor Manuals and read the reviews from many of those people. But this isn't for everybody, okay? So I'm not going to kid you and say everybody can read order flow. You either will or you won't, okay? And that's one of the reasons we recommend that you do these short sessions, because you're going to find out very quickly if it's just not for you. And that's one of the reasons we have this policy that anybody who buys the Jigsaw tools, we just give you your money back if it doesn't suit you. There's no questions asked. You don't have to tell us why you don't like it. If it's not for you, just give you your money back. Now, one final piece of advice is that if you take order flow on board, don't throw away the things from trading that are working for you right now. You are going to have to go through a learning curve with order flow, but it doesn't mean you throw away everything else, because unless you're a scalper, you're going to be using tools like Jigsaw in context, okay? It's not intended to replace everything else you know about trading, because what can happen is in the excitement of seeing these order flow events play out in real time, many traders jump on these events without considering the overall context where the market's going. And in real terms, that can mean you get into a perfectly valid short trade that gets you 3 ticks, and you exit that trade just as the long trade of the day is setting up. And that was certainly my experience when I was starting out with order flow. It can lead to a little bit of excitement and a little bit of overtrading. Now, obviously, you've got to know what's the bottom line with these tools. And we're not really expensive. It's just under $400 for a lifetime license. And that gives you the ability to analyze an unlimited amount of live markets with the tools. If you want to enter live trades for the depth and sales, there is another charge. It's $50 a month or $500 a year, but that is absolutely optional. One license does allow you to install the software on 2 PCs at the same time, but please don't let your boss catch you trading at work. That has happened to our customers. If you do trade through Jigsaw, you can still manage your trades on whatever existing platform you've got. You can switch between managing on Jigsaw and your existing platform. If you don't trade through Jigsaw, you can still use your existing platforms, Dome and Chart Traders, to manage your trades. And finally, as a thank you for those that are still awake and made it this far through the webinar, there is a coupon code there that gives you 10% off the price of the lifetime license, and that's good until close of business on Friday. So thank you, and now I think we can open for questions.
Well, thank you so much. I would really like to emphasize that so many traders start with so much complexity, and what they're really trying to get at is the order flow analysis. And they start out with all these complex indicators and algorithms. But getting this kind of things viscerally, getting them into your bones so that you have a sense of tape reading from the very fundamental information, I think is very helpful as you integrate those other pieces. So thank you so much, Peter, for walking us through that. There was a lot of information there. It was chock full of a lot of stuff. So if you have any questions or want to parse something out, now's a great time. Chad did ask, can we get the software on demo? And as I understand, you get a free 14-day trial. Is that right? Or money back guarantee?
It's a money back guarantee. One of the reasons we do it that way is basically because from the moment that you get the product, I'm available on Skype. You can come into the room. We're going to give you support. So we just want a bit of commitment from the customer in return for that. And we find it kind of weeds out the tire kickers.
Great. Good point. I once started an alpha program and charged $20, just $20 for a whole bunch of stuff. But that, amazingly enough, that $20 stopped some people. And I think that you're right, that, to get the traders who are serious and who want to really improve their trading by understanding order flow, that will not stop them at all.
Absolutely. And we're a small niche company, so we want to spend our time with people who are serious, basically. That's our goal.
Excellent. Okay, any other questions or comments? You can type them into the question box at the upper left. I think it's on your screen. For which instruments does this work or work best? For instance, does it work well with individual stocks? That was from Tom.
Yeah, it works best. What it works best with are anything that's got intraday traders or anything that's got short-term speculators. So stocks, if you're looking at stocks, my recommendation is stick to NASDAQ because you've got better information on there. Stick to stocks in the, below $80 level and a good 400,000 and above per day in terms of volume, at least $400,000 contracts and above. Futures, obviously, are very well traded, full of speculators. Stocks are full of intraday speculators. Stuff like options, no, not at all. But basically, anything where you've got short-term speculators is effectively where you'd use order flow. Obviously, forex, you don't have any time in sales and you don't have any market depth, so it's pretty much a wash for forex, basically.
Okay, Chad follows up and he says, I take this is for the advanced traders, not for somebody starting out.
Well, prop firms will take guys straight from university and they will sit them down in front of the dome, and these are guys who've never heard of trading before, and they will tell them what to look for, and they will start them that way, and they will not let them use a chart. So no, this is absolutely for beginners. There are some issues with everybody wants to trade off a chart, basically. Everybody wants to trade off a chart. If you look at the guys, the pit traders, they weren't trading off charts at all.
No.
They were trading pure order flow. So basically, prop shops, where they get people in. I mean, a lot of them churn a lot of go through a lot of guys, but basically they focus on order flow right from the outset.
I think that's really important. The challenge is that we all want this external structure and all these answers. But in terms of building your trading brain, in terms of integrating the order flow, at first it looks confusing, but if you're willing to create those new neural circuits and allow the subconscious brain to adopt these pattern recognition abilities, I think that starting out this way is probably better than starting out with a lot of the algorithmic driven charts and patterns and indicators.
Yeah, and the other thing to consider as well is that a lot of traders, they start out, we've got a lot of guys that start out, got $5,000 in their account, therefore they're going to trade the S&P, they're going to trade crude and they need 100 ticks a day, or they're going to trade the S&P and they need 10 points a day. And so they end up just constantly fading the market because they're trying to find the low or trying to find the high. What the prop shops will do, they'll have guys scalping for ticks. So instead of looking for 10 points, you're looking for 4 ticks. And they'll have guys getting in and out of the market, getting in and out of the market, getting in and out of the market. And what happens is they have a lot more trades over a much shorter period of time. And so they get a lot more experience and a lot more experience of being in a trade. And so you look at smaller profits, higher frequency as a way to get more experience of being in trades and how to handle yourself and how to handle trading. But I understand everybody says, well, chart looks simple, I should use that. And 5 years later, they're still saying chart looks simple, I should use that. And the prop shops do exactly the opposite.
Excellent. Okay, Han asked, I trade against the immediate trend of the price action. What tools are the most useful for knowing whether to hold or fold?
Well, basically, order flow immediately after you enter. So basically, what we saw there, the two things, once you get into a position, clear, just get a clean slate on the order flow. So basically, your power meters or your current trades or whatever your order flow tool is, just basically focus on what's hitting the bids and offers. Is it more sellers than buyers? If you've just gone long and you're seeing an overwhelming number of sellers versus buyers and price moving against you, you're done basically. Because you've all seen it. You'll get the pullback. What happens? Your market's moving down. You'll get the pullback. The pullbacks are so easy to read. You get the pullback. It's like rolling a ball off down. From side of one hill up another hill. You just see the ball go up and just slows down, and then it starts rolling back the other way. And that's what it's like with pullbacks. And what you're looking for as it starts to roll back with the trend, you're just going to see that overwhelming selling. And you can look at that visually with a power meter, or you can just see it with the trades printing. You look at a time and sale. But basically, once you're in the trade, just focus on what's hitting the bids and offers, what's trading at each level. And unless they're getting trapped, if you see overwhelming sellers come in, you're done, because they'll push that advantage, basically. They'll push that advantage. You'll see as it pulls back and the pullback starts to end, it just fades. But as they can see, as they start to push to where we're about to break through the old low and continue, boom, they'll start really hitting it. And at that point, you're done.
Okay, thank you. Do you have quite time for one more question? It's a little bit of a long one.
Sure.
Okay. Pete, I think you're great and your site and training is brilliant. My question is, as a newbie to order flow, I find the markets move so fast, lots of numbers. Is there a good time to study when the markets are slow or at the open or close? I'm watching the E-mini. Please, I've been studying technical analysis for many years with no success.
Mm-hmm.
That was from Claudio. Yep.
Oh, well, you buttered me up at the start there. Good answer now. Right, basically, there's an issue right now that, we had a bit of a pullback in the market and everybody got spooked and the VIX spiked. And what you'll find is when the VIX spikes, when the VIX goes above 24, 23, 24, basically a lot of the HFT liquidity disappears. Okay, so all this stuff you hear about, like HFT provide much needed liquidity in the market, it's like, yeah, until we need it. So right now, here's the truth, all right? Right now, the E-mini is a tough market to read order flow because instead of like 700-800 contracts, bids and offers per level, it's 200-300. So it's moving around a lot. If you look at the 10-year and the 30-year, you're looking at the treasuries, Look at the US Treasuries, and they're moving much easier. So markets you can look at: Euro Stocks 50 in Germany, the Bund in Germany, the 6E, the Euro futures, the 10 and the 30 on the Treasuries. Look at those products. The problem right now is those markets that we're in a time where a lot of the liquidity has been pulled, and so it's really jumping around a lot. But all you need to do is just move to a slower market and kind of just earn your stars there, basically. Because what will happen, basically, that liquidity will come back into the E-mini. Without a doubt, it will come back. And when it comes back, it will be less volatile and easier to read again. But I will say that some people just love this kind of market. So I know guys who trade order flow on crude full time, and they love it. They think it's marvelous. They just think it's the best thing, since sliced bread. But to me, it's not doesn't suit my personality. So I think you also have to understand that, maybe when you're new to order flow, take a week or 2 weeks to look at crude, look at the DAX, look at the Treasuries, look at the AS, look at the Dow, and figure out, does one of those markets talk to you? Because you might be a fast market guy, you might be a slow market guy. I mean, it sounds like you're a slow market guy, but don't discount that. But I just think it's a matter of picking a different market right now.
Okay, thank you. Let's do one last question, and then we'll call it a day. The last question from Mayo is, how is this better than level 2? I assume he means NASDAQ level 2.
Level 2, the reason it's different. The reason we use a dome format, I mean, level 2, the dome is effectively level 2, okay? The difference that you have with a level 2 screen, a level 2 screen for stocks is the equivalent of the dome for futures. Now, you can use our dome for stocks, but basically, the level 2 is side by side, and you don't really have it's kind of harder to read because it is side by side. So you'll see the lowest bid by the lowest offer, then the second lowest bid by the second highest offer, and the third lowest bid next to the third. So it's not horizontal. Now, there's some advantages to that in level 2 because there can be gaps between the prices. So when you go to a vertical format of the dome, where the price, we're on a vertical price axis, you can get a lot of gaps. So if you're looking at Apple, you might see the inside offer and then a space of 10 prices and then the next offer. So the advantage of level 2 is on markets where you've got like big spreads. It compacts the information, and that's why I say you better below $80 and higher volume because you don't have those big spreads. But really, with level 2 now, to me, there's not a lot of benefit in the traditional level 2 screen. It used to be you can look at the market makers and all of that stuff, but it really doesn't mean yet a lot now because everybody just puts the trades through Arca anyway, or one of the other ECNs, and you can't really see who's participating anymore. It used to be, you'd see Solomon Smith Barney, and Solomon Smith Barney are coming in, you'd get out of dodge, but you don't really see that on the level 2 anymore, not for a long time. I mean, we're going back a while since that kind of trading was in vogue.
Okay, well, thank you so much, Peter. And if you want to follow through with him, there is that coupon code, and Peter Davies at jigsawtrading.com. Reach him there, or you can go to the website, jigsawtrading.com. It's really easy to remember, jigsawtrading.com. So I want to thank you so much for bringing this analysis. And like I've said, in terms of the psychology of trading, building this pattern recognition ability in your brain, your subconscious has a lot of powerful ability to do that. And seeing these raw tools before they get to all the analytics can really be helpful. So thank you so much, Peter.
No problem, Rich. Thank you.
Again, and this was a real pleasure.
And thank you all. Thanks, Rich.
Okay. Bye-bye.